Let's talk more about the risks out there. Tom Simons is chief U.S. economist at Jefferies. CNBC senior economics reporter Steve Leisman is back with us as well. It's great to have you both here. Steve, is there anything you would unpack, first of all, from the inflation number itself? I mean, is that the main point here, that we're finally getting to levels that are significant in terms of, okay, inflation's still going up, but at a slower pace?
Yeah, a couple things. First of all, if you're going to go into a series here of price hikes that could come from tariffs, this is the best way you want to go in. Well, you could have done 0.1. Instead, you did 0.2 and not 0.3. That's a good number. You had to squint, and even when I did squint, I didn't see too much tariff effect because we did have the 10% tariffs on China that were part of the early February part. Those were later raised to 20%. We are still expecting to have, in the months ahead, tariff effects to come through. The question is how much passes through, and then the question becomes, what is the impact on growth? Kelly, I'm still waiting for that report from somebody who tells me that tariffs will decrease inflation, increase growth, and increase employment. Nobody sent it to me yet.
In the long run, in the 10 to 15, no, let's not.
Let's not have the same.
Let's not
I'm waiting for it.
Yeah.
I'm not baiting you, but I'm just saying.
No.
I'm waiting for that report.
Let's see if
maybe Tom has it.
Maybe Tom has it. Tom, how do you read?
Shaking his head.
Okay, go ahead.
Yeah, unfortunately, I don't have the thread that ties everything together, aside from this sort of view that, in the long run, this combination of policies may work a little bit better than the way it looks in the short run. But you really are, again, depending on a number of, cooperation agreements from different countries and all sorts of other workarounds to offset the impacts of tariffs domestically. So that remains to be seen. But I think to Steve's point that he just made, if we are going to go into a period of time here where tariffs are going to raise prices on certain things, you would want it to be at, coming in with a little bit more disinflationary tailwind behind us. And I think that that's evident in the report. The decline in things like airfare, some of the wild cards, and also just mostly the reversal of a lot of those so-called January effect annual price increases that we saw drive a much higher number in January. Those have now proven, I think, to be more or less temporary and not the sign of a renewed wave of higher prices to come.
So two big questions for you, Tom. One, how many Fed rate cuts should we now expect? I think you are still in the camp of maybe we get 3 this year, which would be a big deal. Maybe the market's there now. And then number two, as we mentioned, the JP Morgan 40% odds. Okay, we all know 40%. We don't want to. We know that number is kind of a placeholder more than anything. But where would you kind of roughly put the odds of a recession at this point?
Yeah, so we have really stayed the course with our rate cut views in total when just looking at how many we were expecting this year. We've been holding tough with our 3 towards the second half. I did make a very small adjustment too, which unfortunately is not reflected on the graphic there. But instead of a kind of like every other rate cut path at the end of the year where the Fed brings the policy rate closer to neutral, rather now I think that they're going to look at potential weakness developing by mid-year, and they'll want to cut back to back. So thinking we'll probably see something closer to like June, July, September. And then by then, I'm hopeful that we'll have a little bit more uncertainty lifting, and maybe we can look towards some more specific policies that'll be put in place that will help to boost growth in the second half of the year and then into 2026. And to the second question on recession odds, I'm always kind of loath to put numbers on them because you can just look at like a 40 or 50% number and say, well, that's kind of it either happens or it doesn't.
Exactly.
But my view generally is that the underpinnings of the economy are still fairly strong, and that we need to see quite a lot more financial market pain in order to undo the wealth effects and weaken household balance sheets to the point where we're at an outright recession.